Welcome to Grow with Purpose. We are talking today with Cameron Earhart, and we're continuing our series on exits and what happens when you want to sell your business. We talk about succession a lot. We don't talk about exits as much, but it is when it's time, it's time. It may be too late to figure it out, right? If you're trying to exit now. So we're trying to get some information out there, get it in the hands of listeners. So if you're ever considering a financial exit, you go in with eyes wide open. So welcome, Cameron. Thanks for helping us unpack this under 3 episodes. This is going to be a good series.
Thanks. Yeah, no, excited to be here. Really excited for today's episode. I think it'll be one of the most practical and valuable episodes. Like if you don't listen to any others, like just listen to this one. Even if you don't exit, like this one is I know it's near and dear to your heart being a CPA. So
Yeah.
I'm excited to jump into it.
Yeah, so we're going to be talking about financial readiness, valuation, and buyer trust, which once we get into a deal, we talked in the first podcast, first episode of this series about, before you start talking to buyers and just that whole mindset and kind of the to-do list before you decide that you want to go to market. Part of this would fall into that category. I'm sure, Cameron, you're going to get into that. But if we talk about financials and what's going on in a business that financially when they're getting ready to sell, where do buyers typically start to lose confidence first when it comes to financials?
Well, if you're providing just raw financials to a buyer, and we'll get into well, what's the other option there? We'll get into that in a minute. But if you're just providing raw financials to a buyer, and they're looking, they're seeing these aren't reconciled on a monthly basis, like right away, red flags. Everything's dumped in December for tax purposes or whenever your fiscal year ends. Like that's a major red flag. They're gonna want to see seasonality and trends and spending habits and so they're not going to be able to figure that out if everything's just dumped in 1 month. So monthly updated financials is huge. Proper categorization, if it's just like, if you just have hundreds of accounts and they're all over the place and it's just hard to really get a grip on, what is happening, like that's another one. Like, are they clean? Are they easy to understand, easy to read? So there's just, that's the kind of obvious face value, what's going to raise some red flags or suspicions
Mhm.
right away or cause buyers to lose confidence. So just clean, up-to-date financials, so incredibly important.
So I'm a seller, and I say, Cameron, I'd like you to work. You've been working with me for a little while now. I know you've kind of talked to me. We've had to do some ad hoc reporting because you don't like the way certain things are presented in my financial statements, or they're not. You say tomato, I say tomato. End of the day, Cameron, I can assure you that our bank account is reconciled to the penny every single month. And I can assure you that every credit card statement is reconciled to the penny every single month. And everything that's in the accounts receivable, in terms of outstanding receivables, is accurate. All the payables are accurate. We never miss a bill. We're good, man. Let's just go to market. The financials are fine. I'm sure, they buy lots of small businesses. I'm sure they're going to understand. And you used a term, you said clean financials versus buyer ready financials. So what's the difference? Unpack that for a second.
Yeah, so clean financials are obviously important. When we say clean financials, we're saying, can can we look at them and can we understand exactly what's happening, and are all of your numbers, all the reconciliations, are they happening on a monthly basis? Is categorization happen properly, or do we have certain expenses, going in multiple categories, right? So that's what I mean when I say clean financials. Like, can I interpret these financials and easily understand them on an ongoing month-to-month basis? Buyer ready financials, though, which is just taking it a step further. This is where it's like, all right, clean financials are great. Buyer ready financials can be a little bit different. And what I mean by buyer ready is, one, have they been audited in some way, shape, or form? And we're going to get into quality of earnings in a second, which is, in our opinion, the best way to say, hey, these are buyer ready. These have been audited through and through. Like there shouldn't be any mistakes. You shouldn't find any discrepancies in these financials. So consistency matters so much when when a buyer is looking at financials, because if they dive in and they haven't been properly audited through a quality of earnings or whatever it may be, and they have some incredibly experienced, intelligent CPAs on their team who start looking at all the reconciliations and all the journal entries and everything that's happening kind of behind the scenes to get to the financials. And they start finding, oh, why is this showing up here in the balance sheet instead of here? But 2 years ago, it was showing up here. Like, why did this change? Where did this journal entry come from? And all of a sudden, you're getting asked these questions that you have no clue how to respond to because like they weren't buyer ready.
Yeah.
And so that's what I would say that's probably I don't know how I would practically try to distinguish the two in layman's terms, but would love to hear your answer as well. Being a CPA, you could probably.
You used a term that has all the CPAs in the audience, pulling their hair out if they have any. If like me, that's not a problem. But you kept using the word audited, and so in the accounting world, audited has a very specific meaning. So there's three types of services traditionally that you would get from your CPA. You could either say, hey, I want audited financial statements, which means they basically means the CPA firm is supposed to trust nothing. They're supposed to take your word for nothing. They're going to come into your business and they're going to verify documentation. They'll basically pull a bunch of transactions. They'll kind of sample transactions. And they'll go to the file or go to the digital vault and they'll say, do we have a purchase order for this purchase? Was the check signed properly? Was it for the right amount? Right. And so if they start finding some irregularities, they'll pull more transactions. And if they can't put their mind to rest, they're eventually going to say, we can't really make an opinion on this because we can't validate the information that's in there. So audited financials, the very highest bar you can set for having somebody come in and take a look at your books. The problem is it's extraordinarily expensive. I mean, you're talking tens of thousands of dollars, if not more, depending on the size of the business, the number of transactions, and how complex it is. So the reality is that hardly anybody does that because it costs a lot, and nobody really requires them to do it. There used to be a day when I started working in this area in the 90s, we had quite a few businesses get audited, and it was because they had a really large loan with the bank, or they had an outside investor, or they're a nonprofit that had a grant requirement, and so they require an audit. And that's great for CPA firms. It's very lucrative. CPA firms have a whole section. It's usually split down the middle. There's the tax group and there's the audit group. Below audit, there's something called a review, where they're basically going to take a look at your financials and they're going to ask some questions. They're going to run some financial analyses to see if things make sense, but they're not going to go in and check all of your documentation. So that's a review. That's still very expensive. We have a client that gets a review and it's about $50,000 a year just for the review. And then you can have a compilation, which is where the bank says, I need you to provide financial statements. You go to your CPA and you say, I need financial statements. He says, okay, here's what I'm going to do. I'm going to print out your financial statements. And I'm going to make sure there's essentially no misspellings in your chart of accounts, right? And we're going to make sure that the math adds up, that the debits equal the credits. So your assets equal your liabilities plus your equity, and your income statement's properly formatted, has the best right headers. And typically we're not going to make any, we're not going to put any disclosures or any footnotes or any notes to the financial statements. We're just going to say it is what it is, bank, take it at face value. And that just makes the bank's life easier because they're not getting something that's, a bunch of rubbish and, they have to reformat it or say the numbers don't add up. So what we find in practice is that very few businesses are going to get reviews. Very, very few are going to get audits. But I think one of the things that can help is usually, like, even at that compilation level, if you've had to submit your financial statements on a regular basis to someone who's going to maybe it's a loan covenant for a line of credit or a mortgage or an SBA loan, or it's a bonding company. A lot of bonding companies are going to require you to submit financial statements every year. That's better than nothing. So we find that those businesses who, as part of the industry practice that they're in, they've had to submit these, you're not just going to send it out the door without having somebody look at it. Your CPA is going to look at it. He's probably going to notice something, or she's going to look at something and be like, why is this account negative on your balance sheet when it should be positive? Oh my gosh, let me go ahead and look, right? And so you make some adjustments and you send them back, and she goes, that looks better, right? So at least you've done that. At least you've got a practice of going through it. And the other thing is, there's such a wide variety of engagement by tax CPA firms when it comes to preparing your tax return at the end of the year. So a lot of business owners think, well, of course we've got clean financials. It's February. We just had our tax return prepared. We just
Right.
submitted our books and we got the journal entries back. But you are making a great point that it is common practice for the CPA firm to just take whatever adjustments needed to be made throughout the year. They find mistakes, they find reclassifications, depreciation hasn't been entered. Maybe we're renting the building to ourselves, but we didn't record that because we weren't actually making a payment. The business was just making a payment to the bank instead for the mortgage. Well, that's a rent expense, but my point is the CPA firm, they need annual numbers to prepare an annual tax return. So they're typically not going to concern themselves with, well, should this adjustment be on May 3rd or August 6th? They're just going to say 12/31. And put all these adjustments. And we get financials when we start working with a client. We'll ask for as much financial information as we can get. If we can get the entire history of the 30-year company, we'll take it. And we use that for our financial analysis. And when we plot these trailing 12 numbers that we like to use, we see these big, swings and jumps and jagged lines, and we kind of mouse over it. And it's like, yep, December, yep, December, yep, December, yep, because that's when all the adjustments are being slammed through. So even if you have somebody looking at your financial statements, it does not mean that you're ready to subject yourself to the kind of scrutiny that a buyer is going to bring, because they're going to ask for, well, you're asking for monthly financial statements for probably, 4 or 5 years, minimum 3.
Yep.
They're going to see those jigs and jags, and they're going to be like, what the heck is going on here, right? And it just raises more questions. So one of the things that, you can't rewind the clock, right? I can't go back and say, well, would it have been worth it to get these reviewed, and pay several $1,000s a year to have them reviewed so that I wouldn't have this problem? Well, that's water under the bridge. We're here today, Cameron. We gotta do something. The financials kind of are what they are. What do we do? What's the solution to that problem?
Yeah, the solution is a quality of earnings. And for a buyer receiving, let's say we receive raw financials that maybe they've been audited by your CPA every year, what is even more valuable to them than that would be a quality of earnings report. And so quality of earnings report is basically, there's CPA firms around the country that have departments who specialize in quality of earnings. And it's where exactly what you said earlier, they're going to go in and they're going to start from scratch pretty much. And they're going to rebuild your financials, and they're going to ask you dozens of questions. They're going to check everything, and they're going to make sure that we're presenting the financials in as clean and accurate of a way as possible. But it goes a step further. It's not just that. That's important. But they're also going to build out your EBITDA, your earnings before interest, taxes, depreciation, and amortization. So they're going to get, okay, what is our defined EBITDA? They're also going to figure out what your adjustments are, what your add backs are, or discounts. And so as an example, let's say as a business owner, maybe there's some personal expenses that you're running through the company. Those would be add backs. Those aren't going to carry over to the buyer. Maybe it's one-time expenses. Maybe you had a lawsuit where you had to pay, $40,000 legal fee. That's an add back. That's not going to carry over to the buyer. So they're going to go through and they're going to help determine what are all the add backs in this company that we can adjust out, and then they're going to have what's called your adjusted EBITDA. And your adjusted EBITDA is going to be what we just talked about earlier, your earnings before interest, taxes, depreciation, and amortization, plus all of those adjustments. So you might have trailing 12, you might have a net income of $1 million. Your trailing 12 EBITDA might be 1.25. your trailing 12 adjusted EBITDA might be 1.5. And when we're looking at, those are just, throwing out random numbers, but usually that adjusted EBITDA is going to be the highest number because
Mhm.
every business has expenses that are flowing through that aren't going to carry over to the next buyer. So that is incredibly important to understand because when buyers, especially private equity, when they're valuing your company, they're going to want to understand what is the adjusted EBITDA and then what multiple are we willing to apply to this adjusted EBITDA. And so if it's 1.5 and we are willing to apply 3x, we're willing to pay you $4.5 million for this company. And so if you're not getting the quality of earnings done, that's going to be hard for you to figure out on your own. It's going to take a lot. Like, sure, a CPA could come in and do it, but when they see, like, your CPA pays your taxes, but when they see, hey, this is a legit, credible CPA firm who specializes in quality of earnings, and they put together this report, that is going to bring just a trust, a confidence, and credibility to your financials that you wouldn't have outside of that. And the other part is the buyer's going to do their own quality of earnings. Once they get into due diligence, any sophisticated buyer, any private equity firm is going to perform their own quality of earnings.
Mhm.
And you don't want to have to go up against that CPA firm. You don't want your CPA to have to go up against that quality of earnings firm. So you need to, my preference, my opinion is get the quality of earnings done before you go to market. You're going to have so much more confidence in your valuation and in interpreting or analyzing the offers that you're going to receive. And then knowing that the buyer is going to do one anyways, you're going to have a leg to stand on it, and you're going to have a relationship with a firm that's going to be able to defend you. So it could cost you anywhere from 30,000 to, depending on how big the company is. I mean, it could get upwards of 100,000. But if we're talking, let's just talk on the lower end. Let's say you had to pay 30 to 50,000 for your quality of earnings. I promise you, it is worth it. Like, I mean, they will destroy you if not.
Yeah.
So
Yeah, and it's like you said, it's a multiplicative effect because for everything that you haven't identified and haven't found that they find that they could use to legitimately say, well, this business isn't making as much money as you say it is. It's not just that dollar amount, it's 5x or 3x or 7x, whatever the multiple is that you would expect that business to trade at, given a lot of other factors we'll talk about. It's that times whatever the multiplier is. So yeah, so
yeah,
if you spend 50 grand on a quality of earnings and they come back, and the example you gave, you go from 1 million to 1.2 million to 1.5 million adjusted EBITDA by the time the firm's done with it. That's a $500,000 delta. At times three is $1.5 million difference in your purchase price. And I don't think nobody's happy to write a $50,000 check, but if they have to write a $50,000 check to have a 30 to 1 return, that's pretty good. Right. So,
right.
when you talk about, I think it's what you said is super important for potential sellers to realize. The other side is going to do this. Is
Yeah.
Unequivocal. They are going to do a quality of earnings, and they're paying the big bucks too, and they're hiring their own CPA firm, who's probably gets a lot of business from them, and have proven themselves to be worth the investment. Like, they're paying these guys because it's worth it for them to pay it too.
Yeah.
And it's kind of like if I wind up in jail because I did something stupid, and I'm like, Cameron, I need an attorney because the prosecutor, who's an expert in criminal law, is going to come after me for this, and I need an attorney. And you go, don't worry, the guy who looked at our lease agreement, he's an attorney. I'm sure he could represent you. I'm like, no. I need a criminal defense attorney. And so you want to have that person in your corner who can go toe to toe, so to speak. Not that there's animosity. We've been in these transactions, and man, it just makes it so much easier when the buyer has engaged this expert. We're on the call with them, with our expert. The buyer is on the call with their expert, and these two groups are talking to each other. They speak the same language. Like, yeah, we saw that too. Understand why you asked that question. We've got a schedule. If you guys want to print out the GL reports, we'll send over what we have, send what you have over to them. I think this is going to answer their question. And it's just, I never walk away from those conversations being like, I wish the owner wouldn't have spent that money. That was wasted money. I walk away going, thank goodness we did this.
Yeah. Yeah, 100%. Yeah. So it is worth the money. And I mean, I'll just repeat it because I think it's worth repeating. Don't wait until you're under due diligence to get your quality of
Oh,
earnings
yeah,
done.
that's a
Get
great
your
point.
quality of earnings done before you go to market.
Yeah. Yeah, it takes time. You do not want to rush the CPA firm that's doing this for you through it. And
Yeah.
by the time you get into due diligence, you're going to have so many other questions coming your way. You do not want to be trying to navigate finding a firm to do this for you.
Yeah.
Well, let's talk about the valuation expectations of a seller versus the market reality. Why do owners and buyers often have such different valuation expectations?
Yeah. I mean, it's for just think about it from the seller's standpoint for a second. So let's start there. Like maybe you're at the country club or just getting lunch or dinner with some of your business owner friends, and you hear these multiples thrown out, like, oh yeah, I sold my company for 12x. I sold my company for 15x. And if you're not experienced financially, like you really have no idea what that means. And so it's like, well, 15x of what? Like,
Mhm.
like what is that? What is that of? Like, and so it could be, I mean, you need to find out. Like, are you talking adjusted EBITDA? If you're talking adjusted EBITDA, like what, okay, well, what industry are you in? Right? Because that plays a difference as well. There's some industries, it's just a hotter market than others. Like we saw this with HVAC really over the last, what, 7 years or so,
Mhm.
where some of the multiples getting thrown out there were just unreal, like 12x, 13x, et cetera. And it's also, when you look at multiples, typically the higher the EBITDA, the higher the multiples. So if you're talking, hey, this is a $50 million EBITDA company, you might start talking some pretty significant multiples. If you're talking, well, this is a $1 million EBITDA company, and when I say EBITDA, I'm meaning adjusted. You might say, okay, well, maybe this is like a 4x, like
Mhm.
maybe a 3x. It depends on the industry. So there's so many different factors, but I think it's just important for the seller to do their research, have their conversations before they go to market about what are realistic expectations. And it's very easy to find that information out there. So if you're a roofing company, for example, it's very easy to go online and find, hey, what are some common multiples that roofing companies are selling for, and according to their EBITDA range, so one's in my size. So there's a lot of different, factors I would say to consider and to look at, but there's uh, there's really two main elements of what's driving that multiple. And when buyers are evaluating the company and they're maybe initially, they're reading the SIM, the confidential information memorandum, and they're looking at the financials, maybe you've done the quality of earnings report, and they're seeing, hey, you're a 5 million adjusted EBITDA company. And 5 million, the multiples right now are around 5 to 8x. So hey, we're willing to go under a letter of intent, LOI, for 7x. We'll pay you 7x on 5 million for this company. Well, then they're going to get into due diligence. And when they're in due diligence, they're going to look at what are all the intangibles of this company. They're going to try to get an idea before they
Mhm.
go under LOI. But in due diligence, they're really trying to understand, like, hey, do you have recurring revenue? Do you have margin stability? Do you have customer diversification, management depth? Can we pull you out and run this company? And if you're checking those boxes, you're going to be able to stay at that higher multiple. If they start finding red flag here, or another risk here, risk here, risk here, that's going to drive your multiple down, where they might be coming back to you a month, 2 months into due diligence and saying, hey, we can't pay 7x
Mhm.
because of this reason, this reason, this reason. We could pay 5x. And all
Mhm.
of a sudden, you're like, okay, like my valuation just dropped significantly, and because you didn't really understand what goes behind those multiples. So
Yeah.
that's why it's important just to understand all the factors.
I think it's also important to to say that the reason that people talk in terms of multiples of an earnings number, an adjusted EBITDA number, is because it's just a good shorthand.
Yeah.
The reality is that the buyer is not buying that business on an EBITDA. They're explaining the purchase price they're willing to pay in terms of an EBITDA because that's generally accepted among sellers. They've heard that term a lot, multiple, 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 like the country club guy 15x, the guy across the street 5x, whatever.
Right.
What the seller or what the buyer is actually doing is going back and they're building their own model of where we think the revenue in this company is going to go over the next 5 to 10 years, where we think the expenses are going to go, where we think the market is going to be. And they're building this very complicated forecast to figure out what are the cash flows that we can expect out of this business over the next 5 to 10 years. And then they're discounting all of those cash flows at a risk-adjusted rate. So they're saying this is a very risky investment, so we're going to have to require a very high rate of return, so we're not going to be able to pay as much for that cash flow. Or this is a very stable business, not a lot of risk, fairly simple, maybe locked in from a regulation perspective. We don't expect any surprises, so we can take a much lower risk premium on this and get a higher valuation. So when you hear the country club talk at 15x, a lot of times the context that's missing from that is that person went to market with 3 or 4 years of 25 or 30 or 40% growth, right? So they were on this trajectory. So when the buyer did their forecast, they're on this upward trajectory. The guy across the street who got 5x, he'd been kind of flat for the last 3 years. And so the trajectory and the models for that, were not going anywhere. And so he got a much lower multiple. So it is the reason that they're willing to pay a certain multiple is because they know that once they pay you that, they're going to make more.
Yeah.
So there's always more value in it for them than the price, or they wouldn't do the deal.
Yep.
The question that you have to be, figuring out is like, well, what are the things that would affect their perception of the risk in the business? And you hit on a few of them. Maybe we'll come back to that question in a second, but when we're talking, if we just stick to the financial side of things, what are the financial issues that you see that are like immediate red flags? Like, do not pass go, do not collect $200. This is going to be a huge problem.
Yeah, so a couple. One would be customer concentration. So if they're saying, hey, there's this customer here who's accounting for really anything over 10% of total revenue can start to be a yellow flag. But obviously, the higher that goes, the more risk, because their first thought is, well, when you sell, are we going to lose this customer? And if we lose this customer, we're going to lose, whatever it is, 30% of our revenue. So that could be a major red flag for buyers. Inconsistent margins. If they're, hey, why, how come last year you were at 70% gross margins and then this year you're at 50% gross margin? Like 20% drop here. Where your costs increase and you didn't increase your prices. Like, what's going on there? Can we increase prices? Are you locked into these fixed agreements? Like, what exactly is happening? Some others are, if you get too aggressive on your ad backs, that can be a major red flag. Like if you're, if you're trying to say, hey, we have a sales team of 8 people, but we really only need 5 of them. So we're going to add back 3 of the people's salaries because you won't need these 3 people. And then the buyer's gonna be like, well, why haven't you fired those 3 people? How much sales have they brought in?
Right.
Like, what 3 people is it, right? Like, you're being too aggressive. You're trying to pull a fast one. Like, we're not gonna fall for it. That's not, and a really good CPA firm who does your quality of earnings, they're likely doing quality of earnings for buyers and sellers. And so they're gonna understand what the buyer's gonna be looking for. So they're gonna be able to tell you, like, hey, that's too aggressive of a move. We should not go for that. I'm not going to be able to defend it. I don't feel comfortable defending it. So I'm not going to be able to do that. So there's a lot like that. But the great part about a quality of earnings is it's going to take all of this into consideration. It's not just a financial report in the sense of here's your P&L and balance sheet. with EBIT at the bottom. There's going to be several tabs in this quality of earnings report. And one of them, they're going to be looking at customer concentration, and they're going to explain in it and break it down. There's going to be other tabs where they're looking at your margins over time. There's going to be margin analysis, and they're going to be able to explain it. So this is a workbook that sometimes is 20 tabs that buyers are very comfortable with, and they know how to navigate. And it's going to address a lot of the potentially yellow or red flags that buyers might catch on their own if you don't do a quality of earnings.
Yeah. So you spoke to the question I was going to ask is, what are the things that might affect that perception of risk? And you hit on a lot of them, like, well, these guys are just too overly optimistic. We gotta dial this down. We're gonna need more resources, maybe more resources than they have right now. Maybe they've been running too skinny on sales staff.
Yeah.
Maybe they've underpaid some of their people, and they're like, well, if this person leaves because you're leaving, it's going to be 2x to go out and replace them. So some of those things can definitely affect. You talked about inconsistent margins, customer concentration, two huge kind of flags for, like, this is kind of a risky business. Look, like, last year margins were 30%, the year before 15%, the year before that 38%. Like, what in the world is going on? So figuring out what those that's, again, we cannot, maybe this should have been called the quality of earnings episode, but figuring that stuff out before other people take a look at it and start asking questions, money well spent. Let's just say, kind of wrapping it up, if I'm 1 to 3 years away, so Cameron, I want to sell this business in the next 1 to 3 years. I'm not in a huge hurry. I'm willing to wait. Earliest would be a year. I don't think we could be ready 3 years max. I'd kind of like to have this done. What should I be focusing on financially?
Yes. Step one, get clean, up-to-date, reconciled financials. If you need help with that, reach out to us. Access Outsourced Accounting. Be happy to help. Shameless plug. But get clean, up-to-date financials, because when it comes time to do that quality of earnings, it is going to cost you a lot less if they're working with clean, up-to-date financials versus everything is poured into December. So that would be the first place to start. I think when you're probably 6 months out or around that time from wanting to go to market, go ahead and get the quality of earnings done. They're gonna look back over the last 2 to 3 years, and they're gonna put that in the quality of earnings. But let's say they finish that quality of earnings and you go to market in February. Let's say you go under LOI in April, and then your due diligence is 90 days. They're going to easily just be able to do a roll forward. So they can just come in all the months that haven't been added to the quality of earnings yet. They'll knock them out. It'll be much quicker, much more painless, and a lot cheaper than the initial quality of earnings. So it's better to have that foundation and then just let them come in and do the roll forward. So I would say do that about 6 months out from wanting to go to market. But most important thing you do, clean up to date financials. Get to work on that. That's a great first step.
Yeah, and I think, if you're talking about, a lot can happen in 1 to 3 years. We've seen all kinds of scenarios. You may have a son or daughter who wasn't interested in the business, sell their business or decide they want a career turn, and they're very capable and they're like, I want to run this. Well, those clean financials are going to give them a tremendous leg up in terms of understanding what's going on and being able, and like, once they're clean, you can keep them clean. That's the other thing.
Right.
There's no reason that it should all, go south if the transaction has to get put on the shelf for a year or two because some unforeseen circumstance happens. Once they're clean, there's a lot more confidence when it comes to running the business, financing purchases in the business, regulatory, like tax compliance, all of a sudden becomes a lot less of a headache. Your CPA bills probably go down with clean financials. So there's lots of good reasons out. I mean, if the only reason you're cleaning up your financials is because you want to sell your business, we would make the case. Everybody listening to this today, you're gonna exit your business one day. We all are. I am. Cameron, I hope that you're exiting Axiom after me. That you're the guy there that has to worry about those problems. But we're all going to do it. We might as well figure out the financials today and get them in order, and stop playing crazy games or treating it like a mom and pop business. That time for that's long past. So if you got 1 to 3 years, why not just start today?
And to that point, even if you're not thinking about exiting, and your business, most business owners, their business is what percentage of their net worth? 70%
At
plus.
least, I would say
Uh,
under, if you're talking about a business that's under 5 million, I would say it's probably 90%, and the house is a close second,
right. So this
or
is your most
distant second,
value.
really.
Right. Yeah. This is your most valuable asset. If you have zero clue what it's worth, and you're thinking like, well, I'm not going to sell. I have no intentions to sell. What happens if you're forced to? Like,
Hmm.
God forbid, something happens and you really need the money. You can't work anymore.
Hmm.
If you understand the value of your organization, and so if you have clean financials and you're able to like, hey, my company's worth $10 million right now. I have no intention to sell, but I know it's worth about $10 million.
Hmm.
You're going to be able to make wiser decisions in case, God forbid, that moment came where you had to potentially sell your business, where it's forced upon you. So that would be, hey, it's your most valuable asset. Understand what it's worth. You probably have an idea of what your house is worth. Why not have an
Yeah.
idea of what your business is
Yeah.
worth?
Good point. All right. Well, we got one more episode in the series to go. So if you haven't listened to the previous one, might be helpful, but definitely this one can stand on its own. I think this is a topic that everybody is curious about if they own a business. So thank you, Cameron. It's been great insight. Learned a few things today. I appreciate it. And come back for the next episode. If you want some of the things that Cameron and I have talked about in the leadership guide, kind of breaks it down, gives you some things to think about, maybe some action items that you can commit to. You can find that in the show notes. You can also subscribe to it so it lands in your inbox every episode. And I'll kind of give you an update that there's a new podcast out there that you can go listen to. So thank you, Cameron. We will see you on the next episode.